if there's anyone trickling in the waiting room, we can let them in as we go here.
We'll let them in. Okay. All right. Well, thanks for joining us this evening. This is our first in the series of our speaker events for the year. So we're really excited to have Maris Beigel and Brian Parker joining us tonight. Just a couple of housekeeping items before I formally introduce them. Please keep your microphones on mute. We are recording the session, which I hope you did get the notification when you signed on. And if you could please just hold your questions until after the presentation, that would be the best time for Maris and Brian to answer your questions. So welcome, Maris and Brian. And so a little bit about both of them. Maris is a certified financial planner with Ameriprise Financial. He is passionate about supporting his clients with personalized, goal-based service to help his clients feel more confident about their financial future so they can more fully enjoy the present. His team offers investment guidance, portfolio management, and insurance protection solutions to prepare clients for the expected and unexpected events in life. We also have Brian Parker, who is a 529 specialist and Southeast Sales Director for John Hancock Investment Management. Brian has over a decade of financial services experience, and as a 529 specialist, he helps advisors find solutions to college savings and estate planning challenges, and he provides expertise on the unique and diverse benefits of 529 plans. So with that, I'd like to just give you a little bit of an idea of what they'll be speaking about this evening. Maris will be speaking about 529 plans in particular and how they can be used for kindergarten through 12th grade tuition expenses. He'll also kind of compare and contrast some of the other savings vehicles that are available, compare and contrast those to the 529 plans and speak about those a little bit. Also, he'll talk about the mechanics and potential tax benefits of these savings accounts. And he also will discuss how education savings can be put into perspective within the family's larger financial picture. So again, please hold your answers for the end. You can also put questions into chat if you'd like, and we'll get to them at the end of the presentation. So Maris, if you'd like to go ahead, I think we're ready.
Excellent. All right. So Tracy, if you can just make me the host, I will share the presentation. We'll get started here. Perfect. All right. Bear with me, everyone. Perfect. So hopefully you can all see my screen. Excellent. So welcome everyone. Thank you for joining us today. It's a pleasure to be collaborating with Wide River Upper School to provide insights today on education savings plans. As Tracy mentioned, I am a financial advisor located in Annapolis, Maryland. And one of the financial goals my clients commonly have is to provide their children with a good, sound education. And for some parents, that means sending their child to a private school. So maybe they want to lower student to teacher ratios for a more individual learning experience, much like the kind of education that I know Wide River offers those with specialized learning needs. One of the challenges, however, for parents is obviously the cost associated with a private school. Sometimes it's not expected, right? Maybe you were expecting to send your child to public school, but realizing that a private school education might be the better pathway. So we're going to discuss some of the different education savings accounts that can be used to help fund these costs, and largely focusing on 529 plans today. So as Tracy mentioned, not to be redundant here, but we will be discussing some of the 529 plan features and benefits. Brian will be discussing some of the other types of education savings accounts and how they compare and contrast to the 529 plan. There are many different types of 529 plans all across the nation. So we'll be touching base on kind of how to evaluate that a little bit. And then we'll be talking about how 529 plans can be used as a estate planning tool. So we'll move forward here. So 529 plans, they've gained a lot of popularity since they were first introduced more than 20 years ago. But many people still don't fully understand and appreciate all the benefits that they have to offer. So we'll be talking about, I'm sure many of you parents have noticed education costs have risen considerably over time. As a reference point, if we look at college costs, for example, they've risen about 5% annually over the past 10 years. So just kind of putting that in perspective, if those trends continue, today's newborn, which really hits home for myself because I have a 7-month-old at home, will need to save over $52,000 for an in-state public college. And if we're going to a private school, we're talking about $119,000 a year for private tuition. So given these statistics, 529 plans are becoming a very popular way to save for education. They used to be solely intended to help fund college expenses, but the rules have expanded, like Tracy mentioned at the beginning, and 529 plans can now be used for primary and secondary education expenses, which we'll discuss momentarily. But as you can see on this slide, some of the great features and benefits of 529 plans is they don't discriminate a lot. There's no income limitations. So, no matter the tax bracket you fall in, you can contribute to a 529 plan. There's no age limit, so grandparents are free to contribute to these plans as well. And one of the great benefits is retaining control of these plans as the owner of the account. So even though they're for the benefit of another, you as the owner retain control. So moving on here to some more benefits. One of the most prominent features of 529 plans is that your investments inside the plan grow tax deferred. So furthermore, as long as the withdrawal from the 529 plan later on is for a qualified education expense, the money can be taken from the account tax-free at the federal level. And in many states, those qualified distributions are tax-free at the state level as well. So a lot of tax benefits here. That tax-free status pertains to both what you put into the account and any growth that you see from your underlying investments. So additionally, 529 plans have unique and advantageous gifting capabilities, which we'll talk about a bit later in the estate planning section. And many 529 plans, they offer a broad range of investment choices. So choosing these investment selections are something I typically help my clients with, but essentially there are age-based portfolios, static portfolios, and individual investment selections as well. A common question I get from parents who are intending to use their 529 savings for college is, what if my child doesn't end up going to college? And I think this relates to many Wide River upper school parents because I know many students actually graduate and choose a different educational pathway rather than going to college. And the beauty of these plans is that they're flexible enough to finance many different educational pathways, such as tuition for grades kindergarten through 12th grade, qualified vocational schools, approved apprenticeships, and even trade schools. And some examples of trade school professions include healthcare technicians, dental hygienists, construction managers, electricians, culinary professionals, air traffic controllers, HVAC technicians, and real estate agents, just to name a few. So to find an approved apprenticeship or trade school, you can find that through the Department of Labor's website. One of those examples is apprenticeship.gov. if you're curious. Moving on here. Essentially, we talked about qualified expenses. What is considered a qualified expense? For college, it's basically everything that's required for academics. So, anything other than partying, essentially, right? That's not a thing. But these expenses include, you'll see some of these listed on the slide, college tuition and fees, college room and board, college textbooks, computers and other supplies and equipment for college. But some of the other types outside of college is, if a beneficiary actually becomes disabled or has special needs, the rules start to expand, and those types of special needs expenses can actually be used from the 529 plan or be covered from the 529 plan. Additionally, as we mentioned, kindergarten through 12th grade tuition expenses can be covered from the 529 plan, but only up to $10,000 a year. So it's important to note. And again, it's only tuition expenses. So a little more limited than the college range, but again, this is a new benefit within the last few years. That's expanded 529 plans and has become a great benefit for parents. Additionally, a new benefit there is you'll see $10,000 of student loan debt is considered a qualified expense now as well. So essentially, you can use $10,000 from a 529 plan to help pay off qualified student loan repayments for each beneficiary. So that's not $10,000 a year. It's an aggregate lifetime limit per 529 plan beneficiary. But you could actually change the 529 plan's beneficiary to, one of their siblings to help pay off, their respective student loans as well. So at the bottom there, you'll see some of the expenses that are not qualified. Worth mentioning is insurance, sports, club fees, and transportation costs. All right. So next we will have Brian. I'm sorry, I missed a bullet point there, but we covered it verbally. So Brian, you go ahead and take over and talk about some of these alternative education savings vehicles outside of the 529 plan.
Yeah, absolutely, Maris. Thank you, and thank you to echo your comments earlier for everyone dialed in today. So now that Maris has covered kind of 529's 101, what a 529 plan is. Of course, you have a lot of choices when you're saving and investing for anything, but for education as well. So we're going to talk about a couple common investment vehicles that we see, namely UGMA and UTMA accounts. These are unified gift to minors and unified trust to minors accounts. It's called a Coverdell ESA or education savings account. We don't see a lot of these anymore, and we'll learn about that why in just a second. And then taxable investments. In fact, studies will show that the majority, close to 90% of all assets that people save and have earmarked for their children's education sits in that last bucket in taxable investments. That could be a brokerage account, but typically that's going to be in checking and savings. And the issue there is that you're not going to be keeping up with inflation. You're not going to have any potential investment growth. And you heard earlier from Maris the cost of education, close to $60,000 a year for a public school, or $120,000 a year for a private school for today's newborn. Right, so that's something you definitely want to keep in mind. If you have those assets earmarked for education, it may make sense to go into another vehicle. Maris, you mind putting the next slide to cover UGMAs and UTMAs?
Absolutely.
Next one. So the UGMA and UTMA, we'll spend most of our time here. As I said, it's unified gift to minors and unified trust to minors accounts. This is where we'll see most of the assets where typically parents or grandparents are making a gift to the kids or the grandkids. And I'd say is the most common vehicle, outside of 529s. So an UGMA and UTMA is what's called a custodial account. The major benefit of a custodial account is that the owner maintains control of the assets. They can reallocate those assets at any time until that beneficiary reaches what's called the age of majority. Age of majority is when you become an adult. That's typically 18 in most states. In a few states, it is 21. Keep in mind with an UGMA NUTMA, once you make a gift or put money into the UGMA NUTMA, it is no longer your money. It is that child's money. You have the ability to reallocate those assets on their behalf up until that age of majority, but these are no longer your assets. So that beneficiary, they're going to gain control, over those assets. So let's say Maris here, when he was growing up, he had dreams of going to Yale, but he had way too much fun on his prom night and ends up in jail, right? Well, if he had an UGMA NUTMA in his name, he could take that out and he could use it to pay off, guess what, his bail, right? But if you have that money in a 529 plan, you always maintain control as the policy holder, as mom and dad, grandma, grandpa, aunt and uncle. So you can change the beneficiary anytime. You're the one who controls the distributions. You control the investment allocations. If your kid ends up in jail or they don't go to college, you can change it to another sibling, family member. You have that flexibility with the 529 that you give up, with the UGMA NUTMA. Another thing that you really want to consider here is taxes, right? I've never heard of anybody that likes to pay more taxes. So as Maris mentioned before, 529s like a Roth IRA are funded with after tax dollars. They comes out tax-free for education purposes. UGMAs and UTMAs also have some tax benefits. They're subject to what's called the kiddie tax, basically the tax on the child's investment and other income. So the way the kiddie tax works is if the child's under the age of 19 or they're a full-time student under the age of 24 and they don't earn enough money to fund at least half of his or her support, the first $2,200 of that unearned income is going to be tax-free. And then any additional income is going to be taxed at your estate and trust rate. So that's certainly a good benefit. And then once they reach that age 19 or 24 is applicable for their situation, any unearned income is taxed at the child's tax rate, not at the parent's tax rate. So that's certainly a favorable tax treatment, but it's not nearly as good as tax deferred growth and tax-free distributions. So if you're using the assets or plan to use it for education ultimately, it may make sense to use a 529 over an UGMA NUTMA, or if you have an existing UGMA NUTMA, you can actually move that into a 529. I'll talk about that in just a second. The other thing that you want to factor is gifting. So if anybody here is gifting to their kids, you're a grandparent on the call, gifting their grandkids, well, you can make gifts to individuals in a year. If you're a single tax filer, you can give someone $15,000 in a year. If you're married, filing jointly, you can give it to $30,000 in a year. With the 529 plan, actually, you can gift up to 5 years all at once up front. So that's $75,000 as an individual or $150,000 as a married couple filing jointly. So that is a great way to, fund that 529 plan. And I think if many of you, are on this call that, are paying K through 12, right? So if you use the advantages of the 5-year gifting, you're able to fund that, lump sum up front. Then you're able to draw from that, get that tax deferred growth, pay off, your tuition towards K through 12 and have additional savings for, undergrad, community college, tech school, vocational school, et cetera. So Maris, next slide. So once a lot of people hear about all the different benefits of 529s and UGMAs and UTMAs, especially if they ultimately want those assets to be used for education, they're considering moving that UGMA and UTMA into a 529 plan. So you have a couple things that you can do there. So you can just leave the UGMA and UTMA where it is, stop contributing to it, open up a brand new 529, and then you have both an UGMA and UTMA and a 529 plan. You could roll that existing UGMA and UTMA into a 529 UGMA and UTMA. So you have all the benefits of the 529 plan. However, it's still the UGMA and UTMA, so the custodial rules still apply in that the beneficiary would take over as owner at the age of 18. And then finally, the third option is you could roll over that UGMA and UTMA to a 529, stop the contributions there, and contribute separately to another 529. So then you have that control. When you look at one of the major reasons to make those moves, it comes down to financial aid. So if anybody on this call is, high school, junior, senior, you're applying for financial aid, you may be familiar with this. The way that financial aid works is you just take the cost of tuition, you subtract out what's called the expected family contribution, and the result is your pool in which you can get aid. So when you look at an UGMA and UTMA, FAFSA considers that what's called a student asset. So look at 20% of the value of that UGMA and UTMA. So let's say grandma and grandpa funded UGMA and UTMA for little Timmy, grew over time, grew to $100,000. Well, 20% of that is $20,000. You move that into a 529 plan. FAFSA now considers that a parent asset. and only 5.64% of the value of parent assets go against your ability to get financial aid. So just by changing that ownership structure and working with a great advisor with Maris, who looks at the full financial plan, you're able to potentially increase your ability to get financial aid by 14% just by that simple change there. Next slide, Maris. So Coverdell ESA, some of you may have heard of these. You may have some of them out there. We really don't see much Coverdell ESAs anymore. If this was 1999, we'd see a lot of them, and we'll go through this slide pretty quickly. So with the 529 plan versus a Coverdell, you want to think about contribution amounts. There's no limit annually to a 529 plan. Every state sets limits. So for example, John Hancock, the maximum you can give to a beneficiary is $475,000. That would technically be your annual limit. There's some tax and gifting rules that we just kind of talked about briefly that you want to consider. But at Coverdell, you're capped at just $2,000 per year. So you think about the cost of, your K through 12 right now. You think about the cost of, even if it's community college, technical school, in-state school, right? The more affordable option is, if you have really a drop in the bucket there. Additionally, the 529s, you can hold these forever, right? You can change the beneficiary to another member of the family. The IRS defines the family as about 38 individuals, so you have a lot of options there. And you can pass this on from your kids to your grandkids to your great grandkids if you don't use all of it. With the Coverdell, they force you to pay out that Coverdell if you haven't used it by the age of 30, or change the beneficiary to another family member, and they have to use it all by age 30. With how little you're putting in, you're probably going to use it all. But if you don't, and you have to take it out by age 30, you're going to get taxed and penalized. So if you have a Coverdell, make sure you use it by age 30, but you do have those restrictions. With 529 plans, whether you're making $1 or you're Jeff Bezos and making billions of dollars, anybody can contribute to the 529 plan, and anyone can contribute to anyone else's 529 plan. So if you're feeling generous, let me know. I'll get you my account numbers, and we'll set that up so you can make some contributions on my behalf. For the Coverdells, you start getting phased out around $95,000 as a single filer and $190,000 as a joint filer. For control, it's a big thing with 529s is whoever is the account holder maintains control of those assets, right? So you always have control of the assets as the account holder for the 529. For 529s, you may have a state tax benefit depending on the state you're in, the plan you're using, things of that nature. Coverdells don't really have any state tax benefits. And then finally, the nail in the coffin for Coverdells is really the last line item is K through 12. You can use the 529 now for K through 12 up to $10,000 a year for tuition only. So that was really the nail in the coffin for Coverdells. Maybe your tuition's more than $10,000 a year though, so it might make sense to fund both the 529, and the Coverdell. And where the 529 is just tuition only, the Coverdell you can use it for some other expenses outside of tuition. So there may be some situations where it makes sense to have that Coverdell as well. So next slide, Maris. All right, and we'll cover this as well. So 529 plans, right? I always get the question, do I have to use my state plan, or my kids are in a different state, or I live in Maryland, but they want to go to school in Florida, and grandma and grandpa are in New York. Well, what do we do? So first and foremost, 529s are established at the state level. All 50 states have a 529 associated with them. So every single state has a 529 plan. They're all slightly different. Some you have to do all on your own. You can't, get any help for. Some states have advisor sold plans. Some states have tax deductions. Some don't. So we'll quickly go over the map of the U.S. for you here. So we broke it down to 4 colors: blue, green, like a pinkish peach, depending on your screen, and a purple. So we'll start at the bottom. Purple is Alabama. If you're in Alabama, use the Alabama plan. No other options there. Seriously, they will not only not give you a tax deduction if you use an out-of-state plan, but if you use an out-of-state plan in Alabama and you use it for education for a qualified expense, they'll tax you and they'll penalize you at the state level because you didn't use their state plan. So Alabama basically forces you to use their plan. All right, so let's say you're in any one of the other 49 states. Now we're gonna start at the top and go down. The blue states, these are what's called tax parity states. So it's Pennsylvania, Arizona, New Mexico, Minnesota, Missouri, Arkansas, and Kansas. So these are all states that offer a tax deduction, but it does not matter what 529 plan you use. So let's say, for example, Pennsylvania, close to most of us, Maybe you are in Pennsylvania or grandparents are in Pennsylvania. You want to contribute to a 5 to 9 plan. You can use any state's 5 to 9 plan. You can contribute to your kid's 5 to 9 plan, and you still get to take that state tax deduction. That's great. That's how every state should be, but they're not all like that. The next is those states in green, like North Carolina, Florida, Delaware, New Jersey, on the Eastern Seaboard. These are all states that have no tax deduction. So there's no real benefit of going to the state plan. So of course, in cases like that, you want to look at things like what's the investment options, the performance, the fees, do I get to be able to work with an advisor? And then there's these states that are in that pink or peach color. It's tough words. So for example, most of you are in Maryland, right? So Maryland has a state tax deduction that you can only use with the state plan. So if you want to get the state tax deduction, you would have to use the Maryland state plan. However, Maryland does not have what's called an advisor sold plan. So if you use the Maryland plan, you're all on your own. You have to fill out the paperwork yourself. You have to figure out who should be the owner, when should I take distribution to maximize my ability to get financial aid, how should I invest this, based on my risk tolerance, does fit into the rest of my financial plan. Unfortunately, Maryland doesn't offer an advisor sold plan, so you're on your own there. So if you're in Maryland, for example, and you want that expertise, you want your 5 to 9 to be part of your financial plan, that's where you would look for another state's plan. So you want to make sure that, hey, what does the fee structure look like? Does the investment performance, outperform this plan? And remember, even in a state like Maryland that has a tax deduction, you're lowering your state taxes, which in turn increases the federal taxes you pay. And for the full deduction, you're talking about, $175 of savings in a year. So that could be a lot to some people, but in many cases, it's not worth the cost of all the things that you're giving up. Also, you can contribute to the Maryland plan today, take your tax deduction, roll it out to a plan with an advisor, and then you get the best of both, the tax deduction and you get the expertise of the financial advisor. So, and then each state is going to be different, right? Some states have small deductions like Maryland, other states have big deductions. So this is why it's really important. If you're going through this right now, there's a ton of moving parts that you're dealing with, plus having to raise your kids. You're in great hands with an advisor like Maris who can help walk you through every stage of your journey, including things like tax deduction here.
Excellent. Thanks, Brian. So we are going to skip over this financial aid section, but if anyone has questions at the end, feel free to ask us. We can circle back on this. But we will switch over to the estate planning section and briefly look at how 529 plans can be used as an estate planning tool. I'm sorry about that. Looks like the cleaners are in the office here. So this section really pertains to those with very large estates. Perhaps there's a grandparent who wants to give money to the child's education. So we'll take a look at how this works. And if there's questions on this at the end of the presentation, we can circle back on some gifting examples as well. So the beauty of the 529 plan is that all gifts into a 529 plan are considered completed gifts, which means that any money that's deposited into the 529 is removed from the donor's estate. So why is that important? Well, for someone with a very large estate, their estate might be subject to estate taxes after they pass away. And that can have an effect on how much is actually passed down to their beneficiaries. So by gifting money to other family members, charities, or friends while they're alive, they can lower their estate value and reduce or eliminate any potential estate taxes. So typically, a person cannot gift more than $15,000 a year to another person without being subject to potential federal gift tax requirements. 529 plans, however, allow contributors to contribute up to 5 years worth of gifts at once. So that amounts to $75,000. That's 15,000 times 5. $75,000 can be gifted to a 529 plan in 1 year. And the way they do that is the gift of $75,000 is treated as if it had occurred over a 5-year period. In order for this to be successful, that no additional gifts can be made to that same beneficiary over this 5-year period. Otherwise, the gift tax may apply. So an example of this is, grandma and granddad, it could be anyone, we'll use grandparents as an example, could each start a 529 plan in their name for the same grandchild. And that way they could each contribute $75,000 to those respective 529 plans. And that means the child would be gifted a total of $150,000 in 1 year for their education, and no federal gift tax would be triggered. So this would also mean that the $150,000 that was gifted is removed from the grandparents' taxable estate immediately. It's important to note, though, that if the grandparents, or one of them, were to pass away during the 5-year accrual period, the remaining year's worth of gifts would go back into their estate for tax purposes. It's a little bit complicated, but just wanted to show how this can be used as an estate planning tool. The beauty of the 529 plans as well is that, like Brian said, the donor retains control of the assets. So even though the gift that grandma and grandpa made to the 529, even though it's removed from their estate for tax purposes, the grandparents still retain control of the plan since they are the account owners. So they have control over the investment selections inside the plan, and they can even change the beneficiary of the plan if they wish. As Brian mentioned, the account holder can change the beneficiary. You can change it to another family member of the original beneficiary at any time. So maybe, for example, the 529 savings had been building up for Billy over the years, but turns out Billy doesn't need the money because he's attending a public high school, or he's deciding not to go to college at all. But his sister, Susie, she decides to go to private high school as well as college, and she does need the money for education. So Billy's, we can change Billy's 529 plan, change the beneficiary from him to Susie, and use those funds for her education. All right, we will continue on here. And again, if you'd like to see further examples of these gifting strategies, please let us know. But we'll move on here just for some logistical basic features and benefits of the 529 plan. Essentially, you can change your investment options and reallocate the assets inside the plan twice during the calendar year for each beneficiary. If you're changing the beneficiary of the plan, you can change those investments at any time. In addition, if you realize that a different type of 529 plan would suit you better, like Brian mentioned, there's a lot of different options out there. Maybe you move to a different state or whatever the case may be, you can transfer funds from one 529 plan to another once per 12-month calendar period for the same beneficiary. That being said, if you're changing the beneficiary to another family member, you can switch the plan at any time. You're not limited to that one time per year rule. And lastly here, the 529 plan allows you to systematize or automate your savings into these plans. So you can contribute money at any time as a lump sum, or you can do it automatically on a weekly, monthly, or quarterly basis through systematic investing from a bank account or paycheck. And I strongly encourage systematic investing because you avoid that game of trying to time the market. And if you're doing it, for example, on a monthly basis, the money goes in to the market wherever it's at. And that typically is a better strategy than us trying to time things. So lastly, Brian, we'll have you take this last slide and wrap things up.
Yeah, absolutely. So often I get asked, well, what happens if I don't use the money for, education? There's a million different ways we can use it nowadays, but what happens if I don't need it? Or, right now I work in Florida a lot, so it's hurricane season down there. What happens if there's a hurricane and, my house floods, insurance doesn't cover it, and it's large expense, right? What happens if my kid gets a scholarship? So First and foremost, 3 times you can take funds out of the 5 to 9 plan. That's without any penalty. That's if the beneficiary dies. Of course, we don't want to have that happen. That's if you meet the federal definition of disability. Or the third one is if you get a scholarship. So if you get a scholarship, don't worry, you can take out up to the amount of the scholarship from the 5 to 9 plan without any penalty. So the IRS is nice enough not to penalize you. However, they will still be taxed on the earnings in that situation. So the IRS is not so nice where they won't penalize you for getting a scholarship. They will still tax you. So keep in mind that's just on the earnings. That's not on the money that you put in, only the growth there. Also, you know, for anybody that has kids on the call, which I think is everybody, sorry to break it to you, but they're probably not going to get any scholarships, right? I know we all think that our kids are the best athletes. They're the smartest. You know, I grew up in Connecticut. I was the 3rd best swimmer in the entire state. I thought I was going to get some scholarship money. I didn't get a dime, right? Less than 10% of American students will get $1. So most likely they're not going to get a scholarship. If they do, you can take it out without that penalty. But let's just say maybe you overfunded the 5 to 9, or something happens and you need to take those assets out and you're not going to use it for education expenses. Well, that's non-qualified. The way that works is 5 to 9s are what's called a pro rata or proportional distribution. So let's just say you put $50,000 in the 5 to 9 plan, it grows to $100,000, and now you need to take $25,000 out non-qualified. Well, half of that, $12,500, is principal, and half of that, $12,500, is subject to a 10% penalty and subject to taxes. Those taxes are at ordinary income levels, and the tax rate is going to be based on whoever the check is made payable to. The check can be made payable to the owner of the 5 to 9 plan or the beneficiary of the 5 to 9 plan. Whoever that check's made payable to, that's what the 1099 tax form goes to, and that's that tax bracket. So you can see here in this example, let's say you're a parent, you're in the 35% tax bracket. Let's say your kid, maybe they just got out of college, money left over, they're just in the 20% tax bracket. Well, right there, you add that 10% penalty onto each one, it's a 15% difference. So just by making that check payable to the right party, in this case, the beneficiary of the lower tax bracket, or by, you know, maybe if the kid's making a lot of money already, changing it to the other sibling that's in a lower tax bracket, you know, you're potentially saving, in this case, you know, 15%, you know, on, you know, $12,500, you're talking about $1,800 right there that you're saving in taxes just by making that check payable to the right party. So there's all these really unique niche things about 529s that are very important to know when you're, you know, considering funding a 529, taking distributions for education, or of course, if you get into that situation where you need to take a non-qualified distribution.
Awesome. Thanks, Brian. So to wrap up here, everyone, before we start taking questions, you know, I recognize that for many families, paying for a private school education or for college can seem overwhelming. Hopefully today you've gained an understanding of some of these tools that you can use to help fund these costs. But I think where many people are challenged is the question of how does this goal of providing for my child's education coincide or impact the other financial goals that I have, such as retirement or investing or saving for a potential new home. And part of my job as a financial advisor is to look holistically at my client's entire financial picture, evaluate their current financial position, where they stand relative to their goals, and then determine what steps we need to take to help achieve those goals. And my hope is to remove that uncertainty for my clients and give them confidence for the future. So if you're feeling overwhelmed, please don't hesitate to reach out and start a discussion. Tracy, we can bring it over to you, but if there's questions here, I don't know if there's some in the chat box that Tracy, you want to monitor here, but we'll be happy to take those.
Okay. All right, so if anyone, I see some of you are joining a little bit later. If you have any questions, please put them in chat well, actually at this point you can unmute yourself and ask Brian and Maris any questions you have. And I also wanted to let you know, Tori, especially since you joined later, and there is going to be a recording, so I can share that with you tomorrow. So if anyone has any questions at this point, please go ahead and ask. We'll just give it a couple minutes, a minute or so. An uncomfortable minute.
Yeah, I think we
Anyone?
have one question in the chat box here.
Yes. Okay, so what is the best way to change my investments in my Maryland 529 plan? Currently, I have the standard 401k type Maryland 529 plan, and the rate on investment is poor. I do a monthly automatic payment. That's a good question.
Yeah, so I don't know whose name is this, KM. I can't give advice as to, what you should select here. But if you're asking logistically how to do it, you can go online and do that yourself, and they should provide a list of investment options with descriptions of how those portfolio options or the portfolio is invested. I see you have the standard 401k type. I'm not sure what you're referencing there, but I would feel free to elaborate here. But I imagine you're talking about it's an age-based portfolio based on when your child might graduate. Typically those are going to be a little more conservatively invested if the child is, closer, is very, only a couple of years away from entering college, for example. So if you're looking for a little more growth, maybe they're a bit younger, you might choose something with a little more growth opportunity. But Brian, do you have anything to add there?
And I can chime in too, if you don't mind. So yeah, there's two types. One that you pay pre-tax, prepay for college, and then the other one is more of a 401k type where you get, what I mean? It's sort of like your 401k. And so I switched over. I originally, started in DC, and I switched over to Maryland, and so their rate is really poor. And I have contacted the office, and I think that was what you were speaking of earlier, where they don't really have very good advisors to kind of guide you. So I kind of have, I guess, a standard vehicle where it goes, set by age, and it's really conservative. And I just think what I was getting, in rate of return was better in DC than I am getting in Maryland. And my daughter is due to graduate this year.
Okay. Yeah. So I think we'd probably want to look a little bit closer at what you're invested in. This is something I help clients out with, but this is a little bit of a one-off scenario that I think it'd be better suited to maybe have an individual conversation about this. I'm sorry, I can't give you some tailored guidance here, but it would require me looking at your statement a little better.
Okay. No, I totally understand. Finances is very tricky, and you can't give a blanketed answer. I totally get it.
Yeah, that's kind of I have to play within the rules here.
Yeah, we'll get fined or lose our jobs, so we don't want to do that.
Okay, well, I definitely want to play in the rules too, okay? I don't think I want to go to jail anytime soon or anytime at all.
My contact information, though, is in the chat box. So yeah, please don't hesitate to reach out if you'd like to talk more.
All right, thank you so much. I appreciate it.
Absolutely.
Okay, any other questions? I don't see any others in chat, but please go ahead and unmute yourself at this point if you have more questions, or if you feel more comfortable, you can put them in chat.
Yeah, and Brian, I don't know if there's any common questions you get on your end, but it might be helpful for the audience to share those if you know any that come up quite frequently for you.
Yeah, I think a lot of the presentation covered them, but I think one of the ones that maybe we didn't touch on or just breeze upon, and I get a lot, is can there be multiple owners to a 529 plan, right? Because often it's grandma and grandpa, husband and wife, partners, whoever that are funding that 529 plan. The way the 529 works is you can actually only have one owner and one beneficiary. The 529 is ultimately for the benefit of the beneficiary, but the owner maintains control. But what most likely you'll do is you can name a successor owner. So if you were to pass, then that 529 passes automatically to that successor owner outside of probate and all that. right? So, Maris, if you and your spouse have a 5 to 9, maybe you're the owner and you have your spouse as a successor owner, or vice versa. So I get that question a lot. That's one. Another one I get to, and I think is kind of timely around this time, is, who can contribute to my 5 to 9? I made that joke earlier. Anyone can contribute, right? And that's guidance counselors, it's little league coaches, it's aunts, it's uncles, it's, mom and dad, anybody, right? And so I think of, like, growing up, I had this one aunt, she's actually a teacher, a great aunt. And there's, like, I got the same exact sweater. That was, like, a nice sweater. It was like $70, right? 3 years in a row. And we ultimately turned it. I don't know, like, what happened with that cash. I think my mom just gave me the cash. But if you think about that, right, instead of giving your kids, like, another gift or another toy, another sweater, maybe, you come around Thanksgiving time, you're all together with your family for the holidays. You say, hey, like, these are what my goals are. This is what I'm doing. This is what education costs. And as you're thinking about, holiday planning, you hear about supply shortages, all this stuff. The kids, they may not need another, toy, but, maybe you put that $100 into the 5 to 9 plan instead, right? And they gift in the 5 to 9 plan. You give that gift of education, and there's what's called the Rule 72, which if you get average market returns of 7%, your money's going to double about every 10 years. So if you have a newborn at $100, right? By the time they go, it's really $400, and you do that every year, that adds up, and it makes a big difference. That kid is going to say, all right, all my books are covered for my college, or hey, that paid for my computer, right? And all those little things add up and go a really long way.
Absolutely. See, we have a question in the chat box here. Are there any tax credits, grants, private scholarships? I did hear you say there's a little available out there that we should consider. So Brian, I don't know if our presentation covers that in the financial aid section. I could bring up the presentation.
Yes, sir, I couldn't really hear you, Maris.
Oh, I'm sorry. Can you hear me now?
Yeah.
Yeah, I was saying, did you hear the question, Brian?
I just heard something about grants.
Yeah, so they're asking, are there any tax credits, grants, private scholarships that we should be considering? And I believe that might be referenced in the presentation, correct? The slides we skipped.
Well, yeah, I would say yes. There's $6 billion of loans, scholarships, and grants that are available for Americans every single year. In an average year, about $4 billion of that is claimed, and about $2 billion is left on the table. 66% of families that make north of $100,000 will be eligible for some sort of financial aid, but the majority of them do not complete FAFSA. So if you think you make too much money to complete FAFSA, I would say go ahead and complete it anyway. There's a lot of great tools out there. In fact, we actually have a public website. It's what's called product agnostic. It means it has nothing to do with our company. Maris actually has access to it, and you can send this out to everybody after the call. We call it Education Planning Center. Really, it's a tool to give you tips and tricks to help you all the way through your education planning journey. Whether that's finding a test center for your SAT if you're a senior, whether it's tips for saving if you're a newborn. But we have basically a Google search for scholarships, and it's going to show active scholarships right now as of today to year end. There's 5,298 scholarships currently available, right? And that's just for what has not expired from October 6th to December 31st. It takes time to find those scholarships, but I have an aunt. She's got 2 kids. One is a freshman at Ohio State. Sorry, 4 kids, 2 in college, 2 in high school. But 2 kids in college, Ohio State and Bates. So just to give you an example, first kid went to Bates in Maine last year. Pretty expensive school. They do well for themselves. Got no financial aid. They were not going to fill it out for the second kid that went to Ohio State. I was like, you have to. They did. I think it was like 85% of his tuition was covered through financial aid because their income did not change, but their number of dependents enrolled went up, and the cost of total education went way up. And then my aunt uses this tool for the kids that she has that's a sophomore and a senior in high school, because it keeps her organized on when the SAT dates are, all that. So yeah, there's tons of scholarships, grants out there, whether it's doctoral programs, graduates, scholarships for undergrad. So my aunt, going back, they actually were able to find $5,000 a year as well. One of her kids on the tool, right? So whether it's $500 again or 5,000, every dollar makes a difference when you're sending your kids, off to school. Because it's a lot of money.
Brian, that sounds like a really good tool to use. I'll gladly send that out to the attendees. One thing I do want to mention too is, if there are some parents on here that are not currently Y River upper school parents, and we offer, we have financial aid available. We have a plan. And so if you have any questions, I think some of you are considering Y River, please contact Lori Dudley, and I can put that information in chat also. So I did want to mention that, or you can contact me and we can talk about it. Any other questions? We're almost at the 7 o'clock mark. So last chance for questions, please. All right, any final comments, Brian or Maris?
No, we appreciate the opportunity. As Brian mentioned, that tool is really, really helpful, and that's free. So I feel free to get in touch with me to get access to that tool, or if I'm able to have access to the participants' information, I'll be happy to send that out as well. But yeah, really, really helpful for as you're planning for your students or your children's education.
Okay. All right. Well, thank you everyone for attending this evening. I really appreciate it. And thank you, Maris and Brian. There was a lot of really great information. Thank you, Tori, for your comment in chat. Tori is a current parent, and she's saying Russ is absolutely worth every penny. That's so sweet of you. Thank you. So I wanted to, before we go, I wanted to let you know that we do have, as I said, this is the first in the speaker series for this year. So we have a couple of other events coming up. One is going to be November, December. We don't have the date solidified yet, but we will get that date to you.